Hi, both. Thanks for joining us today on our Business Gurus channel, where we will be discussing key business topics to help students grasp the most important elements of their course in preparation for their exams and future career. Let's get started.
So,
Welcome to the Deep Dive. Today, we're taking a closer look at something huge in the business world, corporate environmentalism.
yeah, it's everywhere.
Exactly. And when companies talk about going green, well, it's not just about looking good or, ethics alone. It's a really deep strategic trade-off.
That's right. Our sources lay out this kind of balance sheet, the real pros and cons, the advantages, but also the real hurdles businesses face.
Short-term pain for long-term gain, maybe. We're looking at how putting the environment into the business plan actually works, based on what the sources tell us.
That's the mission, really, to unpack the strategy behind it all, moving past the idea that sustainability is just, a nice to have or purely marketing.
Right.
We're digging into how it hits operations, finance, everything from cash flow, supply chains, getting into new markets, even who you can hire.
Okay, so let's start with the positives, the upside. The reasons a smart CEO would actually push for this,
Mm.
brand reputation seems like the obvious place to begin. It is, and we know consumers say they care. But the key is how that translates into actual business value.
How do you quantify that value?
Well, it shows up directly in customer loyalty.
Yeah.
And interestingly, lower costs to get new customers.
Okay.
So today's consumers, they're really savvy. They often look at a company's environmental footprint. And for many, it's becoming a deal breaker.
So if a business can show genuine commitment, not just, green talk.
Exactly. Verifiable commitment. That builds serious loyalty with the customers you already have. They stick around, become advocates even. And importantly, it pulls in new customers who actively seek out that green choice, sometimes even over a cheaper option.
So it's more than just good PR. It's about capturing a specific values-driven market segment, one that might be more stable long-term.
Precisely. The data suggests that customers loyal because of shared values. They're often less sensitive to price hikes and more forgiving if there are small issues. That brand equity becomes really robust.
Interesting. Okay, let's talk hard numbers then. The big hope is always long-term cost savings, right? Through efficiency.
Yeah, that's often the core of the business case.
But if I'm looking at this seriously, I need specifics. How does going green actually cut costs? It's got to be more than just use less water, surely.
Oh, definitely. The operational efficiency gains, the OpEx savings, are often the most convincing part. And it happens in, well, mainly three measurable ways.
Okay, what's the first?
First is optimizing how you use resources. So yes, using less raw material, but also things like precision manufacturing. That inherently creates less waste.
Less waste and less energy needed to handle that waste, which links straight to the second point, waste reduction itself.
Right. Less waste means lower disposal fees. Simple enough.
Yes, but here's where it gets really interesting for some businesses. Advanced recycling or reprocessing. Suddenly, waste materials, think plastic offcuts, industrial wastewater, maybe even captured CO2, they stop being a cost.
And become.
A potential new revenue stream. It's like trading commodities, but internally generated ones. Turning a cost center into a profit center. That's a powerful shift. Okay, what's the third way?
Energy. Both efficiency and sourcing. Investing in renewables, like solar panels on the factory roof, or maybe geothermal.
Big upfront cost, though, usually. That's CapEx, right? Capital
Yeah,
expenditure.
exactly. A big CapEx investment, but one that can pay off hugely over the long run by slashing or even eliminating utility bills.
Mm.
The sources often point to payback periods of maybe 3 to 5 years. After that, the OpEx savings are significant and, crucially, protect you from volatile energy prices.
Okay, wait, let me jump in there. Profound long-term savings, yes. But that big CapEx needed, isn't that a massive barrier for, say, small or medium-sized businesses? They might not have that capital lying around.
That's a really important point, and the sources do acknowledge this complexity.
So what do they say?
Well, large corporations. They can often absorb that CapEx hit for the long-term OpEx win. Smaller firms. It's definitely riskier. The payoff depends on stable energy prices, the tech working as expected.
Lots of variables.
But there's a flip side. Often there are government incentives pushing these tax breaks, maybe special loans, which can help lower that initial risk. Sort of spreads the burden a bit.
Okay, that softens the blow somewhat. Now, let's shift focus. Away from just saving money and more towards how sustainability changes what companies make and how they make it. Innovation.
This is fascinating because sometimes putting these environmental constraints on a business actually fuels innovation.
How so? Like, limitations breed creativity.
Pretty much. If you tell your design team, okay, cut the carbon footprint 30%, or you absolutely cannot use this specific material anymore, it forces them to find completely new ways of doing things, new materials, new processes.
And that can lead to that first mover advantage, can it? Getting into new markets with something unique before anyone else has figured it out.
Exactly right. We see it clearly in EVs, sustainable fashion. But think about packaging, too.
Like biodegradable plastics.
Yeah, or plant-based films.
Mm-hmm.
The companies that poured money into the R&D to crack those problems early, they now often hold the patents, they control the supply chains for these next-gen materials. That's a huge strategic advantage.
Okay. One last advantage area. The people side, the workforce. How does environmental policy play out internally? This is really crucial for the long-term health of a company. You find that many employees, especially, younger generations, really want their job to align with their personal values.
They want to work for a company they feel good about.
Precisely. So a strong, transparent environmental policy, it genuinely boosts morale, job satisfaction, and it makes the company way more attractive to top talent.
So it's a talent magnet
Yeah.
and helps keep the people you have.
Absolutely. Better retention,
Yeah.
which means lower recruitment costs, lower training costs.
Okay.
The cost of replacing skilled people is really high.
I see. So if your green credentials mean even a slightly lower turnover rate, that can add up to serious money saved each year. It becomes a key part of workforce strategy.
Okay, that's a pretty compelling list of upsides.
Right.
Reputation, cost savings, innovation, attracting talent. But, like we said at the start, this is a trade-off.
So let's flip the coin. Let's look at the downsides, the big challenges, the barriers companies hit when they try to go green.
Right. And we have to circle back to cost, but maybe frame it slightly differently now. Not just buying equipment, but the R&D risk.
A meaning.
Well, creating genuinely new, eco-friendly products or processes often requires massive investment in research and development. And that R&D is expensive, it's specialized, and honestly, it's often speculative. You don't know if it'll pay off.
So how does a medium-sized company, maybe without huge cash reserves, justify spending millions on R&D when the outcome is uncertain? Or when a competitor might leapfrog them anyway? That's the absolute core of the financial challenge for many. They often can't easily justify it. They might not have the buffer to survive a failed R&D project or wait years for a return on investment.
So they're caught in the middle.
Often, yeah. Caught between the high cost of doing sustainability and the pressure, sometimes regulatory pressure, to do sustainability. The sources talk about stranded asset risk, too.
Stranded assets.
Yeah, imagine investing heavily in a super efficient traditional factory, only for new carbon regulations to make it obsolete or way too expensive to run just a few years later. That investment becomes stranded. Oof, that's a terrifying prospect for long-term planning. Okay, moving to the next big hurdle, supply chains. You mentioned complexity. How hard is it to get real environmental transparency there? It's incredibly difficult, monumental, really, because we're talking about Scope 3 emissions here.
Remind us quickly. Scope 1, 2, 3.
Sure. Scope 1 is emissions you make directly, factory chimney, company cars. Scope 2 is emissions from the energy you buy, electricity, heat. Scope 3 is, well, basically everything else.
Everything else.
Yeah, the emissions embedded in the raw materials you buy, how your suppliers operate, how customers use your product, how it's disposed of. It's huge. It spans the globe for many companies.
Wow.
So auditing that entire chain, checking for ethical labor, low environmental impact, tracking where every little bit comes from, it's unbelievably complex and expensive.
Sounds like trying to see clearly in a thick fog.
That's a good way to put it. And the danger, if you can't get the transparency, is you risk accusations of greenwashing.
Claiming you're green when you're maybe not or can't prove it.
Exactly. If a company says its product is sustainable, but they can't actually verify the source for 30% of the components, they're exposed. If an NGO or an activist group digs into that and finds problems.
All that brand reputation work we talked about earlier, poof, gone.
Instantly negated. It's a massive vulnerability. High stakes indeed. Okay, last major disadvantage. The impact on the final price for the customer.
Right.
Because when a company uses better materials, ethically sourced, environmentally superior, maybe requiring new tech to produce those materials, almost always cost more than the standard traditional options.
More oversight needed, cleaner processes. It adds up.
It does. And that increased cost, whether from materials or operations, usually have to be passed on, which means a higher sticker price for the consumer.
And this is where the strategy really gets tested, isn't it?
Absolutely. This is the core competitive tension. If your product costs significantly more, you risk losing market share, especially if your customers are mostly focused on price, on value, rather than on values.
If your sustainable widget costs 40% more.
You might alienate a huge chunk of the market that just needs the affordable option. So the strategic dilemma is target a premium niche, willing to pay more, or invest massively to somehow bring the sustainable cost down to compete head-on with traditional products. That's exactly it. You have to weigh the higher profit margin from those loyal, values-driven customers against the sheer volume you might lose from the price-sensitive majority. It's probably the single toughest trade-off in this whole area.
That lays out the landscape very clearly. Okay, let's use our final few minutes to pull this all together. We've talked about this through the lens of ethics, the environment itself, these critical trade-offs, and also the role of pressure groups. How do those four pieces fit together?
Well, the way the sources seem to frame it, it's like a chain reaction. Environmental concern often starts as an ethical issue, right? The sense of responsibility.
Sure, doing the right thing.
But in today's world, those ethical concerns often get turned into unavoidable business issues by pressure groups.
You mean groups like shareholder activists, NGOs, maybe government regulators, even organized consumers?
Yes, exactly. They're the ones who push the ethical concern onto the company's actual agenda, onto the balance sheet. They lobby for new rules, they organize campaigns or boycotts, and very importantly, shareholder groups file resolutions demanding things like climate action plans or emission disclosures.
So this external pressure forces companies into making those tough strategic trade-offs we've been discussing.
Precisely. The decision to, say, invest that big chunk of CapEx for long-term OpEx savings, or to tackle the nightmare of Scope 3 auditing, it's often not just voluntary corporate goodness, it's a strategic necessity driven by managing the risks these pressure groups create.
Ah, so it moves from being a nice thing to do to being a fundamental business risk we have to manage.
That's the shift. The short-term pain, the high costs, the R&D risks, the complexity becomes the price you pay to manage that external risk and hopefully position yourself for that long-term strategic gain we talked about earlier. Capturing new markets, being resilient to future regulations, attracting the best people.
It demands real foresight then. Understanding how these non-financial pressures can hammer your financial performance down the line.
Couldn't have said it better myself. It forces ethics onto the economic radar.
A really comprehensive look at a huge challenge for modern business. Thanks for walking us through that deep dive into the source material.
My pleasure. Always interesting stuff. And for you, listening, we want to leave you with one final thought from this deep dive. Chew on this. We've seen the advantages of corporate environmentalism often depend on winning customer loyalty, but the disadvantages frequently come down to customers just not being willing or maybe able to pay the higher price for truly sustainable products. So here's the question. If a company does everything right, perfect supply chain, amazing zero-waste product, attracts brilliant, motivated staff, but still needs to charge, say, 30% more than the less sustainable competitor, how much does simple consumer willingness to pay that premium ultimately decide if these corporate green efforts succeed or fail? Is the real burden of this strategic trade-off actually passed on to us, the consumers, and our wallets?
Something to think about. We'll catch you on the next deep dive.
Thanks to both of you for joining us today. You've been listening to the Business Gurus. Let's now hand it over to you. What further questions do you have based on what we've discussed so far? Leave a comment and we'll get back to you right away. If you haven't already, hit that follow for more business tips.